Hi, my name is George Dagnino. I'm the editor of the Peter Dac Portfolio since 1977. And what I would like to show you with this presentation is what is my investment outlook as of May 2020. What I would like to show is that if you use very simple business information about what happens in the business cycle, you can find many important things like what kind of market you should be expecting, what is the strategy you should follow, and what kind of investment you should have in your portfolio. Let me show you how. Very, very simple. The pattern of growth of the economy is very important to decide how you invest your money. And the growth in manufacturing employment is one of the simplest curves to follow. This is when the economy strengthens, here it weakens and slows down. In 2016, starts improving again. In 2018, started slowing down again, and the trend of slower growth is still well in place. Let's see how we can use now this information. This chart shows the 11 sectors of the S&P 500: discretionary, consumer services, communication services, technology, industrials, materials, energy, which is a subset of materials, um, staples, healthcare, utilities, financials, and real estate. The chart shows the performance of these 11 sectors relative to the S&P 500, which is zero growth, from 2016 to 2018. This was the period when, as I showed you in the previous slide, the economy was strengthening. Now, this is very important. The economy is strengthening from 2016 to 2018. Which are the sectors that have consistently outperformed? Discretionary, communication services, technology, industrials, materials, energy, and financials. What are the sectors that have underperformed? Staples, healthcare, utilities, and real estate. These are what I call the defensive sectors. These are the cyclical sectors. So when the economy is strong, the investment should be focused in the cyclical sectors, not in the defensive sectors. Let's see now what happens since June 2018 to 2020, when the economy was slowing down. Again, refer to the growth in manufacturing that I showed you, that from 2018 started slowing down until now. These are the same 11 sectors. Which are the sectors that have outperformed during a period of slowing growth in the economy? What I told you, the defensive sectors, the staples, healthcare, utilities, and real estate. The exception is, of course, technology. Technology is a sector in itself, is a strong sector no matter what. But the point is, if you see the economy slowing down, these are the sectors that are most likely to outperform the stock market during a period of slower growth. But there is another investment that performs very well when the economy slows down, as it did from June 2018 to at least now 2020, and is bonds. This chart shows the performance of long-term treasury bonds. There is an ETF called TLT. The red line is the S&P 500 as of April, and the blue line is TLT, the price of long-term treasury bonds. If you notice, the importance of treasuries, that when the economy slows down, they appreciate in price. But when the economy takes really a serious dive, they really perform. So the point is, bonds are part of the investment when the economy slows down, but they are a wonderful hedge if one expects a dive, a sharp decline in the stock market. And this should be used in every portfolio. This curve shows the business cycle as I compute from market data is exactly the same as the curve that I showed you using employment in manufacturing. The only difference is that a little more timely because I computed every day and every second because I think, again, I computed from market data. But the point is, what this curve is saying, the economy is weakening. This is what is important, not what they will say it might or might not happen, V-shape, L-shape, M-shaped, W-shaped. Forget it. The way I see it, this is the news. This is what's happening. This is the investment outlook. The economy is weakening. How should you invest your money? Well, from here, I told you if you, as soon as you saw this, you should move from aggressive cyclical sectors to defensive sectors. And the more this curve goes up, the more you start investing in bonds, in TLT, because at some point you know that TLT will outperform most likely the S&P 500. In this, they are defense against sharp market declines. So you decrease the the amount invested in defensive sectors, you increase in bonds, and you keep following the same strategy until when? Well, until you see manufacturing employment or this curve start going up, and this will be the time that you start selling your bonds, sell some of your defensive sector, and start moving your money into cyclically sensitive sectors. Is this the time to do that? No. Why? Because this line it sure doesn't look like this one or like this one. It's still plunging. So defensive sectors and bonds is what the investment outlook dictates. As you know, I published the Peter Dag portfolio, which is available on www.peterdag.com. There are also many videos on that in the homepage that are free, absolutely free. I published a book that was commissioned by McGraw-Hill, Profiting Bull of Bear Markets, and I had real great reviews about this book. 2 more books, Easy Ways to Beat the Market with ETFs, and Investing Wisely, It's Easier Than You Think.